Let's shift gears back to the real economy now. The argument in the 2008 financial crisis, early in the crisis, was that we had a problem that was based in the United States, and thus emerging markets would be insulated from it and it wouldn't impact their economy. The reality was eventually they did not decouple and the problems spread globally. So we've got a situation here currently in Europe where the longer these things go on, eventually you get out here and it impacts the broader economy. This is what a normal credit market looks like. And it's all built upon the fact, really, on trust and that these assets here are worth something and the risk is relatively low. These bonds used to be known as risk-free. Well, we all know that the government bonds are no longer risk-free. And this source of funding has been impaired or cut off in some cases, which is impacting these situations here in terms of the markets and loans. The situation has gotten so concerning in some countries, and they're afraid that this is where we're going next here would be a global recession, that some central banks do even more than this. And they've somewhat learned that they may have to just bypass a normal functioning credit market like this. And the way that they've done that is in the United States and in the UK, they do something known as quantitative easing. And quantitative easing really is just pure money printing. The central bank creates money out of thin air and they buy government bonds, which is really an indirect way of financing this spending that's out of whack with revenues. And in Europe and in the United States, the central banks buy these bonds in the secondary market, and you can say they're not financing the deficit directly. Well, that's really just ridiculous because they're creating demand in these bond markets. It doesn't matter whether the ECB or the Fed participates in a bond auction or a new bond offering. If they're in the market buying on the secondary market, like you would go buy a stock, they're impacting those auctions indirectly. So they don't have to participate in the auctions to impact the market. What the market would care about is that you've got that quote-unquote backstop here. The problem under this scenario where you get into pure money printing is the more money that you pump into the system, eventually you start to create inflation. And as inflation rises, it really becomes a situation where you're making your problem even worse because then the interest rates that you have to pay at these government bond auctions will increase, and as your interest rates rise, you run into a problem. So there's a point of diminishing returns and there's limitations with money printing. That's not a long-term solution. And if you study history, money printing ends badly. And why does it end badly? Because when you get to this stage, this is the last stage where the confidence in a currency breaks down, and then you really run into problems. What are some of the potential options for leaders, solutions, and we'll put solutions in quotes? You can inflate your way out of it, which we've covered, which is printing money. You can restructure your debt, which is what Greece is trying to do right now. Instead of owing 100 cents on the dollar, they're trying to owe 50 cents on the dollar. Or you can have an outright default where the bond that you have in your safe deposit box or in your account really just becomes worthless. When you see these are the options that you have, you begin to understand why the financial markets have been so volatile. These are binary outcomes. This is an inflationary outcome where inflation-friendly assets like commodities, precious metals do well, stocks to some degree, especially in the early stages. Under this scenario, you don't want to own stocks, you don't want to own copper, you don't want to own gold. So the market is jumping from they're going to try to inflate their way out of it. No, they're going to default on their debt. And that's why it's been so difficult for investors and investment managers. What that tells us is until we understand the order of operations here, we need to remain extremely flexible. One day it can look like they're going to default, and the next day it can look like they're going to try to print their way out of it. What is the market currently telling us? The market's currently telling us that they think we've got restructuring and defaults coming. Now, why is that? Well, if the market believed the leaders in Europe that no one else was going to default, the spread between the interest rate on an Italian bond and a German bond would not be as wide as it is. If you were very, very confident that there was going to be no restructuring and no defaults in Italy, then you'd load up on those bonds. They're paying roughly 7% right now. The fact that they're paying 7% tells you that the market perceives that there's risk. The other thing that the market's telling you is that spread between a German bond and an Italian bond. It tells you that the debt markets think that the euro is going to have some problems in terms of countries leaving. Otherwise, that spread would be much, much smaller. So as the market and leaders oscillate between possible inflationary outcomes and possible deflationary outcomes, it's important that we remain flexible. One of the reasons why the market does oscillate between default and inflate is what's known as press conference risk. The central bankers and government leaders can change the rules in these financial markets with one announcement. And a great example of that was the week after Thanksgiving. The week of Thanksgiving, the S&P 500 looked extremely weak. It looked like we were headed for a deflationary scenario. All technical indications were that the S&P 500 was going to retest the October lows and probably exceed them. And then the week after Thanksgiving, central bankers around the globe announced a new short-term lending facility, and the market immediately switched from the restructuring default scenario to inflate your way out. So the press conference risk in these markets will continue to remain high, and that really is the source of the volatility and the difficulty for investors. Looking at the options or quote-unquote solutions that leaders have, if you want to try to get elected or you want to continue to run your bank or you're in a position of power, a Band-Aid solution is to kick the can down the road by taking on more debt and using leverage to take on even more debt, and you can keep this thing going a little bit longer. That's the scenario where leaders say, well, we need to buy time and we need to grow our way out of this. Well, it's becoming obvious with the persistent high levels of unemployment that we have and slower growth that when your debt levels get this high, it impacts growth, and it's very, very difficult to grow your way out of it. So trying to buy time by taking on more debt and using more leverage, you're just simply postponing the problem, and ultimately you're making it worse. And why are you making it worse? Because you're taking on more and more debt. That means there's going to be more to restructure or more to default on. And until we get some restructurings or defaults, the economy globally is going to be saddled in a slow growth scenario with persistently high unemployment. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavacco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.